The power of narratives is a fundamental factor in how people understand complex economic and financial events. In a world where variables are countless and uncertainty prevails, narratives offer a form of simplification that makes it easier for people to understand and react to events. Narratives act as lenses through which investors, consumers, and policymakers observe economic reality. This applies to both individuals and institutions like Wall Street, who often create and disseminate narratives that aim to shape market sentiment for their own benefit. A narrative, in the economic context, is not just a simple story. It is a structured set of arguments that attempt to explain a complex phenomenon in a way that is understandable and, often, persuasive. These stories often contain a mix of facts, assumptions, and predictions. They offer a worldview that can influence behavior and decisions on a large scale, affecting everything from investment decisions to government policy. For example, after the 2008 financial crisis, a dominant narrative was that excessive banking deregulation and Wall Street greed were the main causes of the crisis. This narrative not only shaped public perception, but also influenced subsequent policies, such as the passage of the Dodd-Frank Act, which imposed stricter regulations on banks. Even when circumstances change or when contrary evidence emerges, these narratives often persist, rooted in collective psychology and institutional memory. The resilience of economic narratives is, in part, due to human nature. People have a natural tendency to look for patterns and create stories that explain the world around them. When a narrative is repeated enough, it can become an accepted truth, even if it is based on an incomplete or incorrect understanding of the facts. This acceptance can be so profound that people begin to ignore or reinterpret evidence that contradicts the dominant narrative. Additionally, narratives are powerful because they offer a sense of predictability and control in a world that often feels chaotic and unpredictable. For investors, believing in a specific narrative can provide the confidence needed to make risky investment decisions. For policymakers, narratives can provide the justification needed to implement policies that might otherwise be unpopular or controversial. However, the danger of narratives is that they can oversimplify reality, leading to decisions that ignore important nuances. When narratives become dogma, they can prevent people from seeing the true complexity of the situation and ultimately can lead to serious errors in judgment. In economics and finance, where the consequences of decisions are vast and often irreversible, over-reliance on simplified narratives can be especially dangerous. Federal Reserve Pivot Narrative. A particularly influential narrative on Wall Street in recent years has been the Federal Reserve's pivot. This narrative revolves around the expectation that the Fed, after a period of rising interest rates, will eventually change its policy and begin reducing rates, signaling a shift to a more accommodative stance. The idea of a pivot has become something of a mantra among investors and analysts, shaping market expectations and investment strategies. The pivot narrative gained traction especially in the summer of 2022, when many began to believe that the Fed was about to reverse its monetary tightening policy. This occurred in a context where the U.S. central bank was raising interest rates to combat rising inflation. The expectation was that at the end of 2022, the Fed would begin to reduce rates, which would encourage markets and boost economic growth. However, this narrative turned out to be premature. Instead of lowering rates, the Fed continued to raise them, taking them to levels not seen in over a decade. The Fed's objective was clear: to control persistent inflation, which was well above the 2% target. Even in the face of evidence that the Fed was not ready to pivot, the narrative continued to be widely discussed and promoted in financial circles. This insistence on the Fed's pivot narrative reveals how market expectations can become disconnected from the reality of economic policies. The widespread belief that the Fed would soon reverse its tightening policy led to a series of investment decisions based on erroneous assumptions. Many investors took risky positions on the assumption that monetary policy would become more accommodative soon, only to be surprised by a Fed determined to stay the course. The case of the pivot also exemplifies how narratives can turn into cognitive traps. Once a narrative is accepted as truth, it can be difficult to challenge or dismiss, even when the evidence begins to point in the opposite direction. This type of groupthink can lead to herd behavior, where many investors make the same risky bets based on the common belief that the Fed is about to change direction. Furthermore, the Fed's pivot narrative illustrates the complex relationship between monetary policy and market perception. The Fed, as the main monetary policy body in the United States, has a significant impact on financial markets. However, this influence is mediated by how your actions and intentions are perceived and interpreted by market participants. In other words, it's not just the Fed's actions that matter, but also the narrative that investors build around those actions. This dynamic creates a feedback loop where market expectations can influence the Fed's actions and vice versa. For example, if markets firmly believe in an imminent pivot, that belief could in itself pressure the Fed to reconsider its stance to avoid significant financial disruption. On the other hand, if the Fed perceives that markets are underestimating its commitment to combating inflation, it may feel the need to reaffirm its tightening stance, as happened in 2023. The persistence of the pivot narrative also highlights how market expectations can be resilient, even in the face of evidence to the contrary. This resilience can be explained in part by investors' desire for a return to more favorable market conditions, such as lower interest rates and greater liquidity. When economic conditions are challenging, such as during periods of high inflation, narratives that offer hope for relief tend to gain traction, even if they are out of line with reality. Inflation and the illusion of the price narrative. Fed's pivot narrative is not the only one that has influenced economic sentiment recently. The issue of inflation has also been shaped by narratives that oversimplify a complex reality. Inflation, which refers to the widespread increase in consumer prices, has been one of the main economic challenges of recent years. However, discussions about inflation often mix concepts and create confusion that can distort public understanding. One of the main confusions is the difference between the slowdown in the inflation rate and the actual drop in prices. Many politicians and economic commentators suggest that when the inflation rate slows, it means prices are falling. In reality, a slowdown in the inflation rate just means that prices are rising at a slower rate, but still continue to rise. This difference may seem subtle, but it has significant implications for how people experience the economy. For example, if the inflation rate decreases from 8% to 5%, this means that prices are increasing at 5% per year instead of 8%. While this may be seen as an improvement, it still represents an increase in prices, which continues to erode consumers' purchasing power. However, the narrative that is often propagated is that inflation is falling, which can lead to a false sense of relief among the public. This confusion is fueled by imprecise language that is often used in economic discussions. Politicians and economists who want to convey a positive message may use terms such as falling inflation to describe a slowdown in the rate of price growth rather than an actual drop in prices. This creates a disconnect between the actual economic experience of people who continue to face higher prices and the narrative that suggests the situation is improving. Furthermore, inflation is often treated as a monolithic phenomenon when, in fact, it is made up of a series of interrelated factors. Inflation can be driven by demand factors, such as an increase in consumer spending, or by supply factors, such as supply chain disruptions or increases in energy costs. Each of these factors has different implications for the economy and requires different policy approaches. For example, inflation driven by increases in energy costs, as occurred in 2022 with rising oil prices, is particularly difficult to control through traditional monetary policies such as raising interest rates. This is because higher interest rates do not directly affect energy prices, which are determined by global and geopolitical factors. However, raising interest rates can slow the economy in other ways, potentially leading to slower growth and higher unemployment. Furthermore, inflation is influenced by expectations. When consumers and businesses believe that prices will continue to rise, they adjust their behavior accordingly. For example, consumers may speed up their purchases to avoid paying more in the future, while companies may raise prices in anticipation of higher production costs. These behaviors, in turn, can further fuel inflation, creating a vicious cycle that is difficult to break. Therefore, understanding inflation requires a detailed analysis of the different components that drive it, as well as market expectations. Simplified narratives that suggest that inflation is falling or that prices are under control often ignore these complexities, leading to a distorted understanding of the problem and policies that may be inadequate to address it. The role of the Federal Reserve in economic policy. The Federal Reserve, as the central bank of the United States, plays a crucial role in formulating and implementing economic policy. Their decisions on interest rates, asset purchases, and other monetary measures have profound impacts on the American economy and, by extension, the global economy. However, the Fed often operates in an environment of uncertainty, reacting to data that is frequently revised and trying to predict the effects of its policies on a complex and interconnected economy. One of the common criticisms of the Fed is that it tends to be reactive rather than proactive. This means that many of their actions are based on economic data that reflect past events, which can result in a lag between the implementation of policies and their real effects on the economy. For example, if the Fed raises interest rates in response to high inflation, the effects of that increase may not be fully felt for months or even years. During this time, the economy can change direction, making the Fed's policies inappropriate or even harmful. This reactive nature of the Fed is exacerbated by the complexity of economic data and the uncertainty inherent in economic forecasts. Fed economists must base their decisions on a wide range of economic indicators, including inflation rates, unemployment, GDP growth, and a myriad of other factors. However, these indicators often tell a conflicting story, and interpretation of the data can vary widely among different economists and policymakers. Furthermore, the Fed's actions are often influenced by political pressures. Although the Fed is technically an independent institution, it does not operate in a political vacuum. The Fed's decisions can have significant implications for the incumbent administration, especially in periods close to elections. As a result, there is a growing perception that the Fed is more political than it admits, with its policies often shaped by electoral considerations and pressure from lawmakers and other influencers. For example, during the COVID-19 pandemic, the Fed implemented a series of extraordinary measures to support the economy, including massive asset purchases and reducing interest rates to near zero. These policies have helped stabilize financial markets and support economic recovery, but have also raised concerns about the long-term impact, including rising debt and the risk of asset bubbles. As the economy began to recover, the Fed faced the difficult task of withdrawing these support measures without destabilizing markets, a task complicated by market expectations and political pressures. The relationship between the Fed and the financial market is a classic example of how narratives can influence economic policy. The concept of Fed put, for example, refers to the belief that the Fed will intervene to support markets in times of crisis, a narrative that gained traction after the 2008 financial crisis. This expectation of intervention can influence market behavior, leading investors to take on more risk in the belief that the Fed will always be there to rescue them. However, this dynamic creates a dangerous dependence where markets become overly dependent on the Fed's intervention, limiting their ability to act independently. Times of crisis. On the other hand, the Fed's pivot narrative discussed earlier also exemplifies how market expectations can put the Fed in a difficult position. If the market strongly believes that the Fed is about to change direction in its monetary policy, this could create additional pressure for the Fed to act in accordance with these expectations, even if economic data does not justify such a change. This dynamic can lead to a situation where the Fed is constantly trying to balance market expectations with economic reality, a task that becomes increasingly difficult as market expectations become more entrenched. Furthermore, the Fed's policy is limited by the institution's own mandate, which is twofold: to promote maximum employment and maintain price stability. However, these objectives may conflict at times. For example, during periods of high inflation, the Fed may need to raise interest rates to control prices, but this could lead to an increase in unemployment. Likewise, in times of high unemployment, the Fed may need to keep interest rates low to stimulate growth, but this can fuel inflation. Fed's two mandates creates a constant challenge for the institution, especially in a volatile economic environment. The Fed must balance its actions to prevent an economic crisis from spiraling out of control, all while maintaining public and market confidence in its ability to manage the economy. This requires clear and effective communication, something the Fed has strived to improve over the years. For example, the Fed has begun adopting a more transparent approach to communicating its policies through regular press conferences, meeting minutes, and detailed reports. This greater transparency aims to provide the market and the public with a better understanding of the Fed's intentions, which can help align expectations and reduce uncertainty. However, even with this transparency, the challenge of predicting and managing market expectations remains significant. The role of psychology and the supply chain in inflation is a multifaceted phenomenon that involves a combination of economic factors, including the money supply, aggregate demand, and the global supply chain. However, an often underestimated aspect of inflation is the role of human psychology. Inflation expectations play a crucial role in determining how inflation actually manifests itself in the economy. When consumers and businesses believe that prices will continue to rise, they adjust their behavior accordingly, which can actually fuel inflation. This dynamic is known as the price-wage spiral, where price increases lead workers to demand higher wages, which in turn leads companies to raise prices further to cover labor costs. Higher works. This cycle can continue indefinitely if inflation expectations are not properly managed. This is why central banks like the Federal Reserve strive to anchor inflation expectations by clearly communicating their goals and policies. In addition to expectations, inflation can also be driven by supply chain disruptions. The global supply chain is a complex network of producers, suppliers, and distributors that spans multiple countries and continents. When this chain is interrupted, whether by events such as natural disasters, geopolitical conflicts, or pandemics, the effects can spread throughout the economy, leading to increases in production costs and eventually consumer prices. For example, during the COVID-19 pandemic, there have been significant disruptions to the global supply chain, affecting the availability of everything from semiconductors to staple foods. These disruptions have led to product shortages and price increases for many goods and services. Even when demand remained constant or even declined, prices continued to rise due to difficulties in obtaining raw materials and transporting goods. These supply-driven inflationary pressures are especially difficult to combat through traditional monetary policies. Rising interest rates, for example, won't solve semiconductor shortages or global shipping delays. Instead, these policies can exacerbate problems by slowing economic growth and increasing the cost of credit for businesses and consumers without necessarily addressing the underlying causes of inflation. Furthermore, inflation driven by supply chain issues can have lasting effects on the economy, even after the initial disruptions have been resolved. That's because companies can pass higher costs on to consumers in the form of higher prices, and once prices rise, they rarely fall back to previous levels. This price inertia means that inflation can persist longer than expected, even after underlying conditions have improved. Therefore, understanding inflation requires analysis that goes beyond the raw numbers and considers the role of expectations, human psychology, and supply chain dynamics. Without this understanding, policies designed to combat inflation may be ineffective or even counterproductive, exacerbating problems rather than solving